This is MacroVoices, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
Eric, it was great to have Daniel back on the show. Now let's get to that chart deck. Listeners, you're going to find the download link for the post-game chart deck in your Research Roundup email. If you don't have a Research Roundup email, that means you have not yet registered at MacroVoices.com. Just go to our homepage, MacroVoices.com, and click on the red button over Daniel's picture saying, looking for the downloads. Okay, Eric, what are your thoughts on equities here?
Well, of course, everybody's talking about the death cross on the daily chart this week on the S&P. Death crosses are sometimes false signals, but in my experience, if they don't reverse pretty soon, within 2 or 3 sessions, they usually portend much more downside to come. So if we're going to see this reverse into a false signal, we'd have to see a whole lot more upside on the S&P happen really quickly in order to reverse this death cross into a golden cross, and so far, there's no sign of that. I'm watching the S&P to test its prior support level from early March down around 55.20 or so. I say down around, that was the lows then. Of course, it's going to be up around that level if we manage to get back there, where I'm going to be adding some size to my hedges and with much wider put spreads than I used last time. My lower strikes will be 4,500 or lower, and I might just stick with outright puts depending on how the spreads are priced when we get there and we get back above 5,500, which is what I'm waiting for. Now, to be clear, I have absolutely no clue whether the next big move here is going to be up or down. If we had several countries come to the negotiating table, negotiate deals with the Trump administration, kind of give the signal that this very, very aggressive negotiating strategy of President Trump's is actually working, well, maybe that could lead to a big move up and a big sigh of relief. My risk, though, is on the left tail, so that's where I'll be hedging.
Well, Eric, I want to start off just by looking at where we are on a volatility basis. So on page 2, I have the VIX, which is trading around the 31 handle. And with a 31 VIX, that creates a daily implied range of the S&P of over 105 points. So the key takeaway is that daily volatility and 100-point swings in the S&P is par for the course in this kind of a market environment. Now, we had an extraordinary market bounce the last week, and the observation to make there is that while we had about a 1,300 point S&P drop from its peak to trough this year, we in a span of just a couple hours retraced 50% of that entire decline in one shot. And so we're at a very neutral state. Overall, the big puzzle to solve is whether or not there's going to be a recession and whether it's going to impact corporate earnings. And this is why I think the earnings season that we're upon is going to be that critical, looking for guidance from these companies as to what expectations there are. Because if we have a corporate earnings contraction and some form of a recession that becomes a reality, then the S&P 500 has plenty of room to go lower. There was a Goldman Sachs piece put out there talking about just if the multiples came in while earnings were contracting, that we could, for instance, at an 18 multiple for earnings that contract 10%, you could easily make an argument of an S&P under 4,000 on the downside. So it's going to take several months to determine whether or not we're going down that path. So at this stage, I'm in the camp that this S&P 500 is going to muddle along here into this corporate earnings season and into the jobs numbers that come in the first few days of May. And so it wouldn't be a shocker for us to see a 5,500 or 5,600 print on the upside of the market. But in general, if this is a bear market and if there's is going to be a continuation to the downside, then the upside should only be limited at this stage from these levels. So what all our listeners can take away from this is that that if going into next week and the week after that the market is struggling to make any upside bullish progress to higher than the 55 or 5600 zones, consider the market highly vulnerable for continuation patterns on the downside. Not making that call yet, and we'll definitely have another episode from which we'll be able to review that. So Eric, let's move on and talk about this US dollar. What are your thoughts here?
We tested a 98 handle briefly on the Dixie this week. That's down 10 whole big handles from the high back, what was it, around the 1st of April at 109 spot 45. We're now more than 10 points below that, just holding 99 spot 35 at recording time. So I think it's very clear that a strong downtrend is in play and is likely to continue, and I also think that's exactly what Trump and Bessent wanted.
Well, Eric, you have to go back to 2023 to see a period where the US dollar printed under the 100 handle. And so the fact that we broke down these levels now is really an indication of just how weak the dollar is. Now, to me, the fact that we got down here and we didn't have a reflexive market bounce, which is very typical even in currencies, for there to be a quick rally, let's say back to 101 or 102 from an oversold state. The fact that we aren't bouncing is showing that the dollar remains very distributed, and there are a lot of sellers that keep leaning into this. And so at this stage, every day that passes that this dollar doesn't muster up a meaningful reaction implies that there is vulnerability for this trend to continue to the downside. The bigger question is what kind of downside and what kind of time frame for that. Well, I mean, the one thing I'm going to anchor on is if this 100 level doesn't end up holding and it doesn't become the low, the only logical place to be watching is for this to return back to the levels where we were in 2021 and early 2022 before the bond bear market. And those were levels down near the 90 handle, and that would be a full 10% lower on the dollar. Now, that would be a trend that would take almost all the remainder of the year to happen. I don't see a dollar crash happening where, we're going to be here by May or June down at the 90 level, but it certainly could put in place a trend that will continuously see the dollar in a distribution cycle, and the prevailing downtrend stays in place throughout much of the year. Will this materialize? To me, the bulls need to save the dollar here and now above the 100 handle with a solid rally. And if every day that passes here that this is not happening, makes this highly vulnerable for a new downtrend to be the dominant one. All right, Eric, let's touch on crude oil.
Well, the market hasn't managed to close above the 13-day moving average since the 1st of April, and it's approaching that at recording time. A daily close above the 13-day moving average, which right now is at 69.92 on WTI, would signal that there may be more upside to come. There's still considerable backwardation in the first year of the forward curve, and that's another bullish signal that once the tariff tantrum blows over, there could be plenty of room for another leg up. But I don't have a strong directional view either way on this market. Let's see what the news brings.
Well, Eric, technically, I want to observe that $65 to $66 range on crude oil was an enormous support line that was established over the last 2 years. And we decisively broke below that support line. In a technical analysis, when a major support line like that is broken, what was previously support acts as overhead resistance. Now, as crude oil rallies here and bounces off of its oversold levels, one of the things that we're watching is whether or not that 65, 66 level acts as huge overhead resistance from which crude oil would fail and then continue to retest lows, if not even make lower lows. There's a primary downtrend in crude oil. Price action is very distributed. The bounce was very weak. So while I think crude oil is cheap, and in fact, I actually think that there's going to be a bull phase for crude oil later this year, but right now this trend is very, very weak. And you have to respect that this prevailing trend may stay dominant on the short term. And going into the early part of the summer, there could be still further deterioration on the downside. All right, Eric. Now, on page 6, I have that chart of gold. What a move. What are your thoughts here?
Well, this rally in gold has been unrelenting, and I'm convinced that it's because investors around the world are starting to question the long-term viability of the U.S. dollar as global reserve currency and the U.S. Treasury bond as the central bank reserve asset. However, it's important to note that we've come an awfully long way up in an awfully short amount of time, and that means that a change of sentiment around those stability issues for U.S. dollars and U.S. Treasuries could bring about a very steep and very rapid correction in gold if that sentiment changed for some reason. But absent such a change, I think there's plenty of room for more upside. As far as bringing new money onto the long side of this trade after we've already come up so far, call spreads make much more sense than outrights here if you're going to put new money to work on the long side of gold.
Well, Eric, the observation I want to make here is that even during the worst part of the decline, gold had a little bit of a liquidity air pocket where it quickly went back to retest its 50-day moving average. But the moment that selling subsided, gold rips to a fresh new high and is bought on dip. There is some very strong accumulation here, and it's accelerating. The slope of the rise is turning full on parabolic. Now, number of measured moves are finishing here, but during parabolic phases, this is where prices can get stupid, and therefore I'm not ready to call a market top on something that is moving with this much momentum. The first logical target zones for a continuation pattern would be hitting 35 to 3600 on the upside. But one of the things to just watch here is how gold behaves during dips. If we continue to see, like, let's say drops $50 or $100 over a couple days and immediately gets bought on dip and rallies right back up to highs, then you notice that strong accumulation remains dominant. There's obviously a lot of global central banks that are diversifying into gold, which is certainly a huge tailwind. But the question is that will speculators on the short term drive this into an accelerated rise? At this stage, I wouldn't get in the way of this bull, and let's see where it can reach on the upside. All right, Eric, let's touch on uranium.
Well, Patrick, we've seen a nice, healthy bounce off the lows on uranium issues, but now the slow stochastics on most issues are high and wavering. So it's time for the next swing low down to begin. Will that be to yet another new lower low? Well, I think that's going to depend on the broader equity market, but there's plenty of room here just from the technical signals to say this bounce is over, so now maybe it's time for the market to test new lower lows if this relentless downtrend is going to continue. Now, I remain uber bullish intermediate to long term, but the trend is your friend, and this trend is still down until proven otherwise.
Yeah, to me, I keep it super simple here. Overall, there's obviously a great fundamental story to uranium, but this price action is outright distributive. Lower highs, lower lows, no follow through on rallies. The Sprott physical uranium, which I have on page 7, continues to sell at a deep discount to the net asset value of spot uranium. There simply is no investor interest right now of putting money to work here. Now, that will change, and that's the whole point of observing the charts, is to try to identify that moment when a new accumulation cycle begins. Right now, there's no sign of it. Obviously, spot prices have been far more stable than the Sprott physical. That should put a floor underneath this, but the puzzle to solve is when will we see something technically bullish, like this thing is ready to go. Now, Eric, let's touch on copper.
Well, remember I said the thing to watch was copper's recovery relative to the S&P to gauge whether or not we were seeing a bona fide recession signal with that recent weakness in Dr. Copper, or if it was just moving in sympathy with the general panic over the tariff tantrum. Copper has moved and remained above its early March lows, while the S&P has not. So if it stays there, if it stays above that level of about 4.63, that tends to imply that it's safe to fade that recession signal that we were seeing. But a close back below 4.63, especially if it stays below that level for a few days, would mean that the recession signal is back on and should be taken seriously.
Yeah, what an extraordinary drop we saw over the month of April, where this thing wiped out the entire gains for the year in one fluid motion. Now we've got a bounce back to the 50-day moving average, back to a 50% retracement. And this is actually a level that should arguably be a kind of a neutral zone for copper, which is it likely doesn't have a big upside from here. And if the whole market turns over, we could see copper prices going right back down to the $4 level and retesting those levels we saw all of last year. Finally, Eric, I just wanted to, on page 9, take a quick look at the silver futures. This is particularly the December 2025 contract. We've now heard Powell twice, once with the FOMC meeting minutes, and the second time he just most recently did a speech. What we continue to see is a Fed that is focused far more on inflation and being cautious rather than being accommodating. I think that this, in some degree or another, has lots of risk of being a policy error. And then when things continue to deteriorate, market will have to quickly price in a far more dovish Fed that has to respond. To me, there's lots of room for this to go up to the 97.5 level on the upside in the weeks and months to come. I continue to be buying the dip here, anticipating that at some point the market is going to have to start pricing in a more dovish Fed. The last chart I want to touch on is the T-bonds, and clearly the basis trade has put a lot of stress on bonds. So far, I want to observe is that the bounce has been relatively weak. And to me, whether or not I take a more neutral stance or be far more bearish is going to have a lot to do with how fast the bonds can recover on the short term. If we see that this has started a new distribution cycle in the long bond and the prevailing price action continues to be fundamentally weak, we could end up seeing this long bond heading back to its 2023 lows just after the bond bear market. And so this is going to be something we'll talk about in the weeks to come.
Folks, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading. The details are on the last pages of the slide deck, or just go to bigpicturetrading.com.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.